The K-1 form. It's a tax form that always arrives fashionably late and confuses everyone. A K-1, what is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, and we're back with another installment of What Is That?, where we discuss key financial term and topics you may have heard, but we make them super easy to understand. Let's start with the basics. A K-1 form is a form that is issued by a partnership, an S corporation, an estate, or a trust. When that type of business or entity files its tax return, within it, it generates a K-1 form for each owner. Each owner, partner, shareholder, beneficiary. No matter the name, if you have an interest in the entity, you're getting a K-1. You see, the U.S. Federal Tax Code allows for a shifting of tax liability with pass-through entities, whereby the actual entity doesn't pay any tax. It's each individual that has an interest in that entity that pays the related share of tax. So the purpose of the K-1 is to report the earnings, income, deductions, losses, credits, distributions of that entity and its pro rata share for each investor, partner, or beneficiary. So let's get into an example. Imagine you and your buddies pool your resources to invest in a bakery. You're now churning out some delicious treats, but the bakery itself doesn't actually pay any income tax on those earnings. You, as a partner, are responsible for its share of sweet success or bitter loss. So the K-1 is essentially a report card for each investor. It's going to detail the income, deductions, credits, and distributions you have personally experienced as a result of being X% of owner within this bakery with your buddies. Armed with your K-1, you can now do your personal tax return where you will report that K-1 and all the information on it. It's important that I mention that K-1s are not issued by themselves. They are issued as part of one of the documents within the business tax return. Now, let's address the elephant in the room. K-1s have a reputation for being a bit complex. You see, they contain a bunch of numbers and a bunch of codes where even the most seasoned taxpayer might be feeling a little confused. Here's why they're so annoyingly tricky. The first is their complexity. Again, they have a bunch of numbers, a bunch of codes. They're reporting a variety of information. Let's say you're invested in a partnership that owns an asset that it rents out. There might be rental income on that K-1. If that business has an investment account that receives interest and dividends, there might be separate figures for that as well. The K-1 might also contain things like special depreciation deductions, distributions, and other items, thus leaving many taxpayers wondering what it even means. Another reason they're tricky is their notoriously late arrival. You see, because K-1s are part of a business tax return, the process in which putting a business tax return together can be pretty complex, especially when the bookkeeping isn't up to date. So we find, as CPAs and accountants, that usually a business will extend their tax filing, giving them more time to get all their information together for the business tax return. And since K-1s are a part of that business tax return, this is why they are notoriously late. Another reason why the K-1 might be tricky is the alternative minimum tax. You might be required to pay alternative minimum taxes depending on what's on that K-1 form. But despite its challenges, don't fear the K-1. When you have a really great CPA, they can not only tell you more about what your K-1 means, but also the tax implication it's having on your personal tax return. Hit the like button, subscribe to our YouTube channel, and don't forget to follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.